Narrator: what if you could email money anywhere in the world, in seconds 24/7, for pennies, without your balance bouncing up and down like a crypto roller coaster? That's the promise of stablecoins. Today we'll unpack how they work, real-world uses, the risks, and the new rules shaping them. B-roll. Fast cuts of airport departure boards, code scrolling, supermarket pause, globe animations. What is a stablecoin, and what it is not? Narrator: a stablecoin is a digital token designed to maintain a stable value, usually pegged 1-to-1 to a fiat currency like the US dollar. Think of it as internet cash that lives on blockchains but priced like familiar money. Technically, it's a token on a ledger. Ownership moves when a transaction is recorded on the blockchain. There are two big families you'll hear about: fiat-backed, aka e-money tokens, under EU rules. Each coin is issued when someone deposits one real dollar, or euro, into reserve assets like cash and short-dated government bills. Coins are destroyed when redeemed. This mint and redeem mechanism helps keep the price at $1. EU MiCA calls these EMTs, broader asset reference tokens, ARTs, track baskets of assets. Algorithmic designs try to hold a peg using code and market incentives. Several have failed dramatically, e.g., Terra, Luna in 2022. Regulation now distinguishes these from fully reserved fiat-backed models. On-screen text. Stablecoin does not equal Bitcoin, volatile, mint, redeem at $1. EMT versus ART, MiCA. Why people actually use them. Narrator: so why do stablecoins matter beyond crypto trading? Cross-border and B2B payments. Today's correspondent banking can be slow and fee-heavy. Dollar stablecoins can move funds near instantly, any day, with transparent settlement. Even major payment providers now build rails to accept, hold, and convert stablecoins. One widely reported example is Stripe's 2025 acquisition of Bridge, a developer platform for stablecoin APIs, followed by the launch of stablecoin accounts in 100+ countries. This illustrates mainstream infrastructure, not an endorsement. Treasury, working capital in emerging markets. In places with high inflation or capital controls, businesses and freelancers hold dollar-linked coins to preserve value and move money across platforms. Central banks and researchers are watching this closely. Crypto market plumbing. Traders park between volatile assets in a dollar token. DeFi protocols settle loans and swaps in stablecoins. Total stablecoin supply has hovered around the $300 billion mark recently, with dashboards like DeFi Llama tracking flows. B-roll. Animated world map with payment lines. $1 right pointing arrow token right pointing arrow $1. Loop. Screenshots of regulatory websites. No brands, logos promoted. How the peg is kept, and how it can break. Narrator: whiteboard sketch. For fiat-backed stablecoins, stability is about reserves plus redemption. Reserves: high-quality, liquid assets, cash, T-bills, overnight repos. Some issuers publish quarterly attestations by auditors. For example, Tether reports large treasury exposure and an excess reserves buffer in recent attestations. Always read the footnotes. Redemption at par. Authorized users can redeem one coin for $1. Arbitrage closes price gaps. But pegs can wobble. In March 2023, USDC dropped below $1 to $0.87 intraday, after part of its cash reserves were stuck at Silicon Valley Bank over a weekend. It restored parity when U.S. authorities guaranteed deposits. Lesson: banking links matter. On-screen text. Check. Reserves, attestations, redemption, banking partners, key risks and the regulatory turn. Narrator: financial crime risk. The FATF, Global AML standard setter, warns that stablecoins are increasingly used by illicit actors when oversight is weak. Many countries still lag on enforcing travel rule data sharing for crypto transfers. Expect stricter screening and traceability requirements. Systemic, monetary risk and consumer protection. The BIS cautions that many stablecoins fail key tests to function as money at scale, singleness, elasticity, integrity, and should play a limited, well-regulated role alongside central bank money. Europe's MiCA regime is now in force for stablecoins, ARTs, EMTs. It requires one-to-one backing, liquidity, redemption rights, disclosures, and sets extra supervision for significant tokens. EU authorities, EBA, ESMA, are actively refining technical standards and supervisory colleges. The ECB has flagged euro area spillover risks from large non-EU dollar stablecoins and tracks tiny but growing euro stablecoin supply. The UK is consulting on a regime for sterling-denominated systemic stablecoins, Bank of England, and FCA rules for issuance and custody, pointing to full reserve, high liquidity backing and redemption at par. Globally, the FSB has issued high-level recommendations for consistent oversight of global stablecoin arrangements. On-screen text. Rules arriving. EU, MiCA, UK, BO, FCA, FSB, Global. How to evaluate a stablecoin, a simple checklist. Narrator. To camera with checklist graphic. Before trusting any digital dollar, ask 5 questions. What backs it? Cash, T-bills only, or riskier assets? Is there an independent attestation? Who can redeem, and how fast? Are there minimums, fees, or gates? Where's the bank custodian? Concentration in one bank adds risk, as the USDC SVB episode showed. Compliance posture. Is the issuer, wallet provider operating under clear AML, KYC and travel rule obligations? Jurisdictional fit. In the EU, is it MiCA authorized as an EMT, ART? In the UK, would it fit BO, FCA expectations? On-screen text. Backed, redeemable, bank, compliant, authorized, balanced takeaway narrator stablecoins aren't a get-rich asset. They're a piece of payments plumbing. Used well, and regulated well, they can make money move like the internet. Used poorly, they can import old risks into new rails. The smart play is understanding both the tech and the rules. B-roll. Simple, money moves like data, animation, fade to title card.